Hello and welcome to my video presentation. I would like to show you the effects on supply and demand when imposing taxes. Firstly, I will explain you what taxes are. Taxes are a fee levied on a good or service by the government in order to cover the general financial needs of a country. There are two types of taxes: direct taxes and indirect taxes. A direct tax has to be paid directly by an individual or organization and cannot be transferred to another person or firm. Some examples are property tax, income tax, or taxes on assets. An indirect tax can be shifted from one taxpayer to another. On the one hand, there are specific taxes such as the petrol tax where the amount per unit is fixed. On the other hand, there are ad valorem taxes, which are a percentage of the price or value added at each stage of production. VAT is a typical ad valorem tax. Now let's have a look how a tax has an influence on the price by the following example. This diagram shows the supply and demand curve of a dairy factory. Currently, the equilibrium price is €2 and the equilibrium quantity is 3000 gallons of milk. After imposing a tax of €1 per gallon, the supply curve shifts to the left by the amount of the tax. Since the amount of the tax is the same at all prices, it is a parallel shift. In order to produce the same quantity at the same price, producers need to charge the whole tax to customers, which is why the supply curve shifts by the tax amount. However, the demand curve needs also to be considered. Therefore, the price rises from €2 to €2.60 and the quantity falls from 3000 gallons of milk to 2250 gallons. The price does not rise by €1 since the demand curve is elastic. An increase in price leads to a decrease in demand. Consequently, the tax is distributed between consumers and producers. The consumer's part is the balance between the old price and the new price, which is 60 cents here. The remaining balance of 40 cents pays the producers. Another method to calculate the producer's part is to deduct the new price from the tax. The difference between the net price €1.60 and the old price, which the producers would gain if no taxes were imposed, has to be paid by the producers now. This diagram also shows the total amount of taxes the government receives. The difference between the new price P2 and the net price C has to be multiplied by the number of sold goods. Therefore, the government revenue is the rectangle P2ABC divided into the green area for the customer's part and the red area for the producer's part. Elasticity is a measure to show how sharply the consumer's demand changes if there is a price rise. When the price rises, it may take some time until people react on that and change their consumption and buy another product. Therefore, in the short run, the demand curve tends to be more inelastic, whereas in the long run, the demand curve tends to be flatter. This diagram shows the supply and rather inelastic demand curve of the same dairy factory at the time when the tax is recently imposed. The original equilibrium price and quantity are the same as in the first diagram. After imposing the tax of €1 per unit, demand equals supply at A, which is €2.90 and 2813 gallons. In this case, the consumer's share of the tax is 90 cents, while the producer's share amounts to 10 cents. The more time passes, the more people will change their purchasing behavior and switch to another substitute product. Consequently, the demand curve is more elastic. Now, the equilibrium point is at €2.20 and 1500 gallons. The distribution of the tax has changed. 20 cents goes to the producers and the remaining 80 cents accrues at the consumers. To sum up, the more elastic the demand is, the more quantity sold falls. Hence, the more time passes, the more government revenue falls since less quantity is sold. Furthermore, the more elastic the demand is, the more price falls and the greater the producer's share of the tax is, whereas the consumer's share becomes less. Finally, I would like to mention that cigarettes, petrol and alcohol are typical stuff taxed with indirect taxes. In many cases, the tax amount accounts almost 50% of the market price. The demand is high and relatively inelastic, which leads to a high revenue for the government. Thank you for watching this presentation movie. If you have any questions, please feel free to send me an email to simeon.dimitrov@edu.fh-wien.ac.at. Thank you.